How are we looking today? How are we going to start,
Pete,
at least?
You might recall yesterday around this time we were talking about the US markets having fallen into a bit of an air pocket, and they ended up being down in the order of 1.5%, which was the worst decline that we'd seen since September, and quite a departure from the recent strength that's featured where US stocks in particular are concerned. So it's nice to report that at least this session the stocks have righted themselves to some extent. They're grinding higher. We're seeing gains in the order of about 0.5% where the three leading indices are concerned. The S&P 500 up by half, the Nasdaq up a little more than Dow up a little less. So importantly, this session there were some growth figures, National Council GDP figures, which were describing the US economy in quite flattering terms. The pace of growth in annualized terms 4.9%, so quite strong, but a moderation from the previous quarter or the previous estimate. But importantly within this, it showed that consumer spending was moderating a little bit. So that eased concerns around the inflationary piece and contributed to a fall in long-term interest rates, and that's what has been supportive as far as stocks have been concerned. So that's one thing to talk about. The other thing is that oil prices took quite a knock last night, Pete. They were down by as much as 3% at one stage because Angola has announced that it will be leaving the OPEC cartel. So that has cast a bit of a pall over things. There's now disquiet over whether or not that might be a pathway for other countries to follow. OPEC has been an organisation that's been marked by quite significant discord in the past. There hasn't been recently, but in any case, that contributed to oil prices falling by as much as 3% at one stage. They've recovered a little bit since then, down by about 0.75%. The point to make is that they're not far off their lowest levels of the year, Pete, notwithstanding everything that's going on in the Middle East.